Good day, traders. This is Roger Scott from Market Geeks with another video trading tutorial for you today. Before I begin, I'd like to remind you to visit marketgeeks.com for your free trading report. And don't forget to subscribe to our video channel for trading tips and videos. Today, I'm going to discuss important day trading rules that many beginners either forget to follow or avoid following for one reason or another. Most often, traders simply lack the required experience to know which rules can make or break their account, and unfortunately learn the hard way after the fact. I hope that this tutorial will help you avoid some very costly mistakes and get you started on the right track. Most day trading tactics are based on technical analysis and momentum techniques. With that being said, many traders completely ignore the fundamental news and reports that are related and relevant to the stock market or other market that they are trading. This is one of the biggest mistakes beginners make because markets are driven by emotions, and short-term fundamental news provides clues as to what is driving the market at any given time. For example, if a stock is coming down with earnings after the closing bell, it will trade very differently than on a typical trading day. Or if economic reports are going to be released within the hour, the index futures market will go through a choppy range-bound period prior to the announcement. Another good example is excessive volatility that typically occurs on stock option expiration day that occurs the third Friday of every month. Most professional traders look at economic calendars after the closing bell and before the opening bell so that they know all potential and foreseeable factors that can influence the market during the following trading session. Many traders begin their day disciplined and ready to execute their trading strategy according to the rules, but oftentimes, as soon as they experience a few losers or the market doesn't do what they anticipate will happen, they forget their trading plan and begin trading based on emotions and pure feel. This is a recipe for disaster and occurs more often than you can ever imagine. What I do each day before the opening bell is prepare for 5 worst-case scenarios, and I write down each of these so if any of them occur, I know exactly what I have to do and how I have to react. This will prevent you much undue stress and provide you with confidence in difficult market situations. There is only so much time in the trading day, and there is only so much ground prices can cover in that time. You must understand that market entry late in the day reduces your profit potential greatly and reduces the odds of trades working out in your favor because they simply don't have the time to work out. Unless you're scalping, which involves taking numerous profits every several minutes, I do not recommend initiating position after lunchtime Eastern Time. You probably heard this rule hundreds of times, but do you really follow it each and every time? The problem occurs after the entry is placed. The mind has a great way of talking us out of doing things that are good for us, so make sure you figure out your stop loss level and place your protective stop order when you get your entry fill back. After you practice this exercise, it will eventually become second nature, kind of like putting on a seatbelt. Avoiding stop loss orders is the biggest reason why small losers turn into large, highly unmanageable positions that can turn your trading career into a nightmare quickly. Don't take huge risks and always protect your positions with protective stop loss orders. Relative strength analysis is simply comparing the instrument that you're trading with a very similar instrument. For example, if you're trading semiconductor stocks, you would compare the stock you want to trade with other stocks in the semiconductor industry group. Or if you intend to trade the E-mini futures contract, you would compare the E-mini NASDAQ to the E-mini S&P futures contract. Relative strength gives you a strong indication of how a strong or weak stock or market is compared to other related stocks or other markets. This offers you some very important clues as to what related stocks or other markets are doing and can give you important information about the stock or market that you intend to trade. If you're going to go long, you probably want to pick the strongest stock out of the industry group. And if you're trading short, you would probably want to pick the weakest stock in the same industry group. Relative strength provides you with the tools to analyze markets and compare strength or weakness between two related instruments. That's it for today's tutorial. I hope you follow this short guide and create a daily routine that you can live with and follow. Thanks for joining us for today's tutorial. Please don't forget to subscribe to our video channel and visit Market Geeks for your free trading report. Thanks for joining us and have a wonderful day.